Hi everyone. This is your domain consulting guy Anuboddo back with the fifth video in our insurance consulting series, which is currently ongoing. So, if you have seen or gone through some of the last videos, you would have seen that we are in our life insurance journey currently. We have covered term life insurance and then whole life insurance, and then in today's video, we are going to look at universal life insurance and variable universal life insurance. So what is universal life insurance, right? So it is another type of permanent life insurance. So what does permanent means? That you can claim at any point of your time, right? At any point of your age, so after your death, the beneficiary of the policy will get the death benefit, right? Now, along with the death benefit, what the beneficiary will also get is a cash value. So this type of a permanent life insurance has two parts to it. One is the fixed death benefit, which is declared. Along with that, you will get an additional amount which we call cash value. Now, this is also the same as whole life insurance, which we have seen in the last video. But the difference in universal life insurance from a whole life insurance is that it allows the insured to lower or upper the premium amount within a certain range, right? So this is the difference, and this is the flexibility. This is the selling point of a universal life insurance, that based on your economic condition, you can upper or lower the premium amount within a certain range, right? Now, however, if the investments underperform, in wherever the company or the insurance company is basically investing your money, if the investments underperform, or the insured underpay for too long, it could affect both your death benefit as well as your cash value, right? That is given for any universal life insurance policy. Fourth point says that the cash value earns an interest rate set by the insurer. So this is another key feature of a universal life insurance, that it earns an interest rate which is set by the insurer, right? So you as an insured, you are not being able to set the interest rate. Also, it is not like it is when we go into universal life or variable universal life, you will see that there you will have the ownership of or independence of investing your money, but here the cash value earns an interest rate which is set by the insurer. So this is another key feature of universal life insurance. The fourth one and the second point, these are the two most important points. And then this is another feature, that if you borrow money against the accumulated cash value, then there is no tax implications, right? Because this is your own money, and against that you are taking a loan or you're withdrawing some amount of the money. So that is also allowable in a universal life insurance. So now we will go into a bit of the basics, right? That how a universal life insurance works. So we have seen that it is giving you the flexibility of adjusting your premium based on your, say for example, at certain point you don't have the independence of paying the entire premium, right? You have faced some kind of a struggle in your life, and then you can lower the premium, and then after that certain period which has gone up, and then you are now again back to your normal earnings, and then you can pay your premium, then you can again increase your premium. So that is the advantage it is giving you. Now, most permanent life insurance, say be it whole life, be it universal or variable universal life insurance, has basically three components to it, right? The first component is cost of insurance, which is basically the amount that is incurred by the company to carry your policy. Then you have a death benefit which the insured is getting, which is the fixed amount, which is basically the declared amount that the insured is getting. And the third amount is the cash value, which is the additional amount that you will get, right? And you get cash value based on if the interest rate in which the company is giving you the cash value that increases, or if you overpay premiums, then that additional amount gets incurred as the cash value amount, right? So COI, which is the cost of insurance, include the charges of mortality, policy administration, and other directly associated expenses, right? So all these add up to the cost of insurance, right? So this cost of insurance is something which you don't get, right? Which is basically incurred by the company to maintain your policy, as we just discussed. Now, collected premiums more than the cost of insurance, right, will add to the cash value and to the death benefit, basically, right? And the other thing we all need to know is, as the age of a person increases, your cost of insurance will increase, right? Because the chances of you facing different kinds of diseases will also increase, or basically chances of you facing death will also increase. So obviously the company increases the cost of insurance component, and hence you will always see that later in your life, as as your age increases, if you buy a policy say 40 years of age, then obviously your premium is much higher compared to if you take the life insurance at an earlier age, right? So if it's 35 or 30 years, right, compared to 40, this is why it is more, because your cost of insurance will increase, but your death benefit will remain the same, right? And obviously your cash value depends the kind of interest rate you are getting from the company and any additional payment that you are giving, right? So now looking at the advantages and disadvantages of a universal life. So the main advantage is premiums are flexible, which is not there in your whole life or in your term life insurances. Then your possible flexible death benefit as well, right? So you have the option of changing your death benefit. It can increase your death benefit if your cash value increases, right? And then potential growth in your cash value is also there based on your increase of interest rate given by the company. And then the most of the policy holders, they also get the advantage of taking loans against the accumulated cash value, right? Which mostly don't have a tax implication to it, right? But obviously you need to pay a very minimal interest at certain cases, and at certain cases you don't also pay interest, right? So that it differs from policy to policy. Now disadvantages of a UL policy, right? Universal life policy. Risk of large payment requirements. So basically what happens is, suddenly if your investments in wherever the company is making your investments for your cash value, that investments are underperforming, right? In that case, the company may ask you to pay large payments suddenly, or otherwise the policy may lapse, right? So that is the one of the downside of universal life insurance. And then obviously returns are not totally guaranteed, right? But in universal life, what happens is they try to guarantee at least a basic level of return, because the interest rate is determined by the company, and normally it's a steady interest rate that is given by the company, although we can't say that it's 100% guaranteed, right? Because it also depends on the kind of investment the company is doing. And then, as I told, that some withdrawals can be taxed, but some other type of withdrawals are not taxed, right? So there's a combination of both, that some of the withdrawals can be taxed. That's one of the downside. Now we will look at what is variable universal life insurance, right? So as you see in the name of the type of life insurance, there's a word called variable, right? So it is very similar to universal life insurance, but the main difference is that in variable universal life insurance, it lets you invest and grow the cash value through sub accounts, right? Which operate pretty much like mutual funds. So how it operates is that you totally own that wherever your additional money, apart from your cost of insurance, the entire additional money that you're investing, you decide through certain sub accounts they did what kind of securities, in what kind of mutual funds, or in what kind of other financial products, be it commodity, be it money market, your money will be invested in, right? So that is variable universal life insurance. So obviously you can easily understand that the chances of returns are really high here if you invest in the right products, and similarly the chances of loss is also substantial high, because in case the products that you choose don't perform, then it will give you high losses, right? So as we discussed, each of the sub accounts acts as it can be a stock product, or a bond, or a money market, or a commodity market, whatever it may be. And then apart from the standard, the other key feature of a variable universal life insurance is it has a little high administrative cost, right? Because the company, if you'll understand, that has to maintain different within the sub accounts, or basically different sub accounts within a certain policy. And then you are investing in different kind of products through those sub accounts, right? So obviously your administrative cost and the mortality fees that you are paying for maintaining these accounts is a little high compared to a variable life insurance or a whole life insurance, right? So it ranges between 0.5 to 2% your administrative cost. So this is another key feature of variable universal life insurance. So the first thing that we spoke about is it is giving you the total independence of investing your money through different sub accounts. And the second part is, but you have to pay a little high administrative cost to maintain variable universal life insurance, right? So thus, although variable universal life insurance in giving you control over the cash value investments has high growth potential and flexible premium as well, but it has the risk of cash value losses in case your investments are not right, possible increase in premiums, again if you have net loss in your overall investment, and high fees and charges for your administrative things of your policy. So these are the key features of a variable universal life insurance. So now we understood that what is universal life and what is variable universal life. So the final thing we'll look at is who is it for, right? Who will go for a universal life, who will go for a variable universal life. So as we have understood the policy so far, universal life insurance is giving you a death benefit and also a cash value. Along with that, the additional feature that it is giving you is giving you the flexibility of changing your premiums, right? You can lower your premium, you can higher your premium within a certain range. So that is the additional flexibility universal life insurance is giving you. But along with that, it is also giving you the cash value based on an interest rate which is to some extent stable because it is fixed by the company, right? It is not, but in a variable universal life, what is happening is it is not, your cash value is not getting determined based on an interest rate. Rather, it is getting determined by the kind of investments that you are doing through the sub accounts to the different products like the in securities or bonds or commodities or money market, right? So variable universal life, the growth potential is even higher than universal life, but the chances of loss is even higher. So obviously, people who know their investment products really well, who know markets really well, who know where to invest how much money, they will definitely go for variable universal life. Whereas people who whose financial knowledge is not that much high, but they want a kind of a fixed return. And also want the benefit of having the flexibility of changing your premiums, they will obviously go for universal life insurance. Hope you understood the two concepts that we discussed today. In our next video, we will look at what is a ULIP insurance. Thank you for your time. We'll catch up in the next video.